Hello everyone. So today we are going to discuss about leverage. Please let me just tell you. So we have 3 units in total for financial statement analysis. So let me quickly tell you about that. So unit number 1, we have then unit number 2 and unit number 3. These 3 units. Uh, this section is called financial statement analysis. And this is going to be your 20% of your exam. Okay. And under unit number 1, so we have these topics. So first topic was relevant to common size financial statements that we have already covered. Liquidity ratios that we also have already discussed. And in the last lecture, we discussed about solvency ratios. So today we are going to talk about leverage. So guys, please remember solvency and leverage ratios. So mostly we use these ratio to assess the risk position of the business. So solvency we discussed last time. So leverage ratios we are going to discuss now. So here we go, guys. First of all, we are going to discuss what does mean by leverage. Leverage definition I'm going to explain. So actually leverage is the amount of fixed cost in the firm's overall cost structure. So please remember here, leverage mean to say we are just going to check or we are going to measure the risk of the business, especially that business which is having the fixed cost. Okay. So actually leverage focus is on fixed cost, right? Because fixed cost always creates the risk. If a business is having a high fixed cost, obviously guys, if a business is having higher fixed cost, so obviously that business is more risky. Why? Because even the small decrease in the revenue, okay, can turn that business into losses easily. On the other hand, if a business is having a lower fixed cost, so that business is considered less risky. The reason is that even small variation in the revenue, a small variation in the sales, okay, maybe it will not turn the business into losses. But as I told you in the first statement, if the business is having higher fixed cost in its cost structure, so if there is a slight change in the sale, especially decrease in sale, that business can easily turn into losses. So that is why leverage is the relative amount of fixed cost in the firm's cost structure. And obviously this presence of fixed cost always creates the risk, right or wrong? Because anyhow, by hook or by crook, at least you have to recover the fixed cost, because if you will not recover the fixed cost, your business will be into the loss. So let me tell you here, usually mostly we use variable costing idea. Let me tell you here first, especially for operating leverage. So how variable costing works, or how we can prepare income statement by using variable costing. So usually we take sales, right? Then from sales we will deduct all variable cost. Okay, and this is called what? Contribution margin. And from there you have to deduct all fixed cost. Okay, so this is known as what? Your operating income. Because fixed cost, as per definition, it will remain constant, it will not change. So obviously if your sale will decrease, so your ultimately your contribution margin may decrease. And if fixed cost is constant, obviously your business might into the loss easily. So that is why the presence of higher fixed cost creates the risk for the business. Now the point is that how many types of fixed cost we have. Usually we have 2 types of fixed cost. Let me define here. So here we have usually 2 types of fixed cost. One is called operational fixed cost. And second is called finance related fixed cost. Operational fixed cost, let me give you idea, guys. Operational fixed cost means to say the fixed cost which you have due to your operations. For example, usually this operational fixed cost will arise due to the heavy usage of plant and machinery. So let me give you examples here. So for example, maybe due to the heavy usage of plant and machinery, you will have a higher amount of depreciation, which is kind of fixed cost, because I'm not assuming here that we are calculating depreciation based on units of output. No. So let's assume you are using straight line or whatever method. So other method, straight line or reducing balance method. So in that, depreciation is fixed because it has no relation with your output. Another, for example, you may have a property taxes. This is also kind of fixed cost, right? Operation relevant. Maybe you may have a salaries, which is also kind of fixed cost, right or wrong? It's operational now. The salary is not arising only due to plant and machinery. Maybe you have a rent, etc. So all the fixed cost, which is relevant to your operation, so that is called operational fixed cost. And and the fixed cost which is relevant to your finance. For example, if a company is taking debt, for example, or you have already taken a debt, so on the debt you have to pay interest cost, right? So interest cost is a kind of fixed cost because this is the contractual obligation that you have to pay this cost, even you have a zero revenue or your revenue is declining, whatever situation, even you are in losses or you are into profit, so you have to pay the interest cost to serve your debt, right? So it means any cost which is relevant to the debt, because debt is the part of financing decision, right or wrong? So any cost which is relevant to the debt, like especially interest, so this is called finance related fixed cost. And any cost which is relevant to operation, that is called operational fixed cost. And please remember, fixed cost, even it is finance relevant or even it's relevant to the operation, so obviously will create the risk. But the point is that how you will measure the risk relevant to the operation. Like if you have any fixed cost which are relevant to your operation, to measure the risk of operational fixed cost, we always calculate operating leverage. We always calculate what? Operating leverage. And to measure the risk of finance related fixed cost, we always calculate financing leverage. Okay, we have our operating leverage and financing leverage. Understood? So here we go. This is what is the 3 points so far I told you. What does mean by leverage? Leverage means say the presence of fixed cost is your leverage. It creates the risk. And we have a two types of fixed cost if it is relevant to operation. So obviously, so that is called operating leverage, and operating leverage formulas we will use to assess the risk. And if fixed cost is relevant to finance, that is called financing leverage. Understood? Our finance leverage, so that we will use financing leverage ratios to measure that risk. So here we go. This is what is written here also. We have a operating leverage, we have a financial leverage also. Understood? And here we go. Let's understand now how to measure the risk of operational fixed cost. To measure the risk of operational fixed cost, we always calculate operating leverage. So here we go. We are going to discuss the formulas now, how to work with the operating leverage. And this is also called degree of operating leverage. Please remember, guys, let me tell you one note. Even let me explain here, because we have discussed here that we have an operational fixed cost and we have a financial fixed cost, right or wrong? So operational fixed cost usually arise due to heavy usage of plant and machinery, I told you, and financing leverage always arise due to the debt financing into the capital structure. Please remember this, plant and machinery is also relevant to balance sheet. So balance sheet related item, debt is also obviously presented on balance sheet as a part of liability. So it means both are balance sheet items. So in leverage, we will actually, even both items are balance sheet, but it will affect your income statement, right? So that is why sometimes leverage is defined this way also, like what are the effect of balance sheet item over your income statement, or what are the effect of assets or liabilities over your profit or loss. Okay. So here we go, coming back to the point. So we were discussing operating leverage, and operating leverage we always use to measure the risk of operational fixed cost. So please remember, as I told you, we always use variable costing basis to measure this risk. So it means we need a data in this format now. Which format we need data? So we need this way. We need always sales, and then we need all variable cost. So this is equals contribution margin. From there, you will deduct fixed cost. Okay, so this is known as your operating income. So this approach is called variable costing approach. So in operating leverage, especially, you have to use variable costing basis. Right or wrong? So here we go. So there are two formulas are there, guys, to measure the operating leverage. So this is the first formula I'm going to explain. This first formula we will apply only if single year data is available. Single year. So that is why here I'm calculating degree of operating leverage, but for single period. So single year data means if single year income statement is available by using variable costing. So how this is measured. So please don't forget the formulas because the basic thing is the formula and the understanding of the formula. Then we can apply these things through the help of the question. Obviously, I'll show you a couple of questions also. So degree of operating leverage. So this formula is for single period. Single period means say here you have a data for 1 year or you have a income statement available for 1 year by using variable costing. So what's the formula here, guys? So here the formula is numerator is contribution margin. And you know contribution margin is always equal to sale minus variable cost. So this is called contribution margin. So numerator is the contribution margin and denominator is the operating income or earning before interest and tax, EBIT. Okay, or PBIT, profit before interest and tax, any word you can use. So numerator is contribution margin and denominator is earning before interest and tax. So let me take you to the income statement. For example, this is our numerator and this is our denominator, right? And if you look at here, the difference between numerator and denominator is what is the fixed cost, right? So ultimately the formula which we are going to use, so that formula will explain the fixed cost as, factor or as variable. Okay, the answer of that formula actually will explain the fixed cost. Okay, so here we go, let me tell you here. So numerator is what? Contribution margin, and denominator is earnings before interest and tax. So here we go, let's have a look. For example, we have a company. So we have two companies. We have a company A and we have a company B. And this is the income statement is available by using variable costing. So we have here sales for company A is 900,000. For company B is also 900,000. And we have a then we will deduct variable cost. We have a 500,000 for company A, 200,000 for company B. And here we have a contribution margin, 400,000 for company A and 700,000 for company B. And then we have a fixed cost, for example, 225,000 and 525,000. And once you will deduct obviously fixed cost from the contribution margin, so you will get what? Earning before interest and tax. Okay. Now look. So how you will apply the formula? So what was the formula if you remember? The formula was contribution margin divided by earning before interest and tax. So here we go. For example, for company A, first we are working. So contribution margin is 400,000. So this is the numerator divided by earning before interest and tax, which is 175,000. Okay. So it means 400,000 divided by 175. So answer is 2.29. We'll understand the interpretation. So then here we have a second company B. We have a contribution margin is how much? 700,000. This is the numerator here. Divided by earning before interest and tax, which is 175,000. If you will divide, you will get the answer 4. Okay. So please, there is the one general rule. General rule is that if answer is higher, so it means the business is having high operational fixed cost. If answer is lower, it means the business is having lower operational fixed cost. This is the general rule of thumb. Higher answer represents higher operational fixed cost and lower answer represent lower operational fixed cost. Okay, so here we go. Now, if you look at here, which company is having high answer? So first I'm just telling you because mostly this answer, which company is having higher answer? First answer this question, guys. So company B is having a higher answer 4 and company A is having a lower answer of 2.29 less, which is less, right? It means this company represents high risk. It means this company, if answer is higher, it means that company is having higher operational fixed cost. Let's check into the question. about fixed cost. So here we have a fixed cost, guys. So company B is having 525,000 of fixed cost, and company A is having 225. Obviously, this is having higher fixed cost. So it means this business is more risky. So you cannot interpret the answer itself. Okay, like what does mean by 4? Actually, as I told you, this answer only is the explanatory factor for fixed cost. So if answer is higher, so you will always assume that business is having a higher fixed cost. And now you have to think why. Why, if answer is higher, the business is having higher fixed cost? Because numerator is contribution and denominator is your EBIT. And we know the difference between these two is the fixed cost, right? If this difference is higher, if this difference is higher, automatically your answer will be higher. If this difference is lower, if this difference is lower, difference means a fixed cost. If difference is higher between these two values, right? Contribution and EBIT. The difference is fixed cost. If difference is higher, it means that business is having high fixed cost. And if difference is lower, it means that business is having lower fixed cost. And obviously the business which is having a higher fixed cost, right or wrong, their answer will automatically be higher also. Because this answer represents the difference actually. Higher answer means a higher difference, lower answer means a lower difference. Simply, this is the only interpretation for this ratio. Understood, guys? And now I'm going to tell you here. Second formula. Second formula. First formula, don't forget. First formula I told you, if you have a single period data, if you have a single year data, so then degree of operating leverage is always measured by using this formula. Contribution margin divided by EBIT or operating profit. Right? But if we have a 2 years data is available, 2 years, so then we will apply this percentage change version. This is called percentage change version. Percentage change. So if you have a 2 years data, for example, you have a 2 years income statement available. Okay. So in that scenario, you will apply this percentage change version. And what's the formula? So here you will calculate degree of operating leverage in percentage. Degree of operating leverage in percentage. And how you will calculate? You will take also percentage change in operating income or EBIT. Okay, we need percentage change. This delta represents percentage change. Percentage change in operating income and divided by percentage change in sales. Now the question is that, guys, how you will calculate percentage change in operating income and percentage change in sales. So guys, 2 years data will be available always. For example, because this formula you can apply only if 2 years data is available. For example, this is year 1 and this is year 2. Let's assume year 2 I'm assuming current, this I'm assuming previous. Obviously, as per number, this is 1 year, this is year 2. This is the recent year, year 2. So for example, here you have a sales. For example, here sale is, for example, 150 and here sale is 200, right? And for example, we have other values also. Let's do, we have a EBIT also, for example, because two things we need, EBIT and sales. Okay, for example, you have a EBIT also. So here, for example, EBIT is 30, here EBIT is, for example, 50. Let's assume. The point is that how you will calculate percentage change. So you will always apply this formula, guys. What's the formula? If I want to work with the percentage change in sales, I take current year sales minus previous year sales divided by previous year sales multiplied by 100. Simply as we calculate the trend, okay? Current year minus previous year divided by previous year multiplied by 100. And if I want to calculate percentage change in EBIT, so same formula I'll apply. I'll take current EBIT minus previous EBIT divided by previous EBIT multiplied by 100. This will give you percentage change. For example, let's apply for the sale. What is current year sale? 200 minus previous year sale, which is 150. Obviously, 200 minus 150, this is the $50, right? Difference. Divided by previous year. Previous year is what? 150. This is the previous year. Now, if I'll take 50 divided by 150 multiplied by 100, so I'll get percentage change in sale. Answer. So same here, if I want to calculate percentage change in EBIT, I'll take current year. Current year is how much? 50 minus previous year is how much? 30. Obviously, 50 minus 30 equals 20. So divide by previous year. Previous year is how much? 30. And multiply by 100. If I take 20 over 30 multiply by 100, I'll get again percentage change in EBIT. Okay. So now the interpretation of this formula, I'll explain with the help of question. Don't worry. With the help of example. So this is what is the percentage change version. But this percentage change version you can apply only if 2 years data is available, right? And what's the formula? Percentage change in operating income or EBIT divided by percentage change in sale. And please remember in this formula, so numerator and denominator are different, right? Because in single period it was contribution margin and EBIT. Here we have a change in EBIT and change in sale. So obviously numerator and denominator is a different, and obviously interpretation will be different also. So for example, here guys, we have income statement. So we have a current year data. Here we have a prior year data. We have a here net sales, then minus cost of goods sold for both year. Okay, equals gross profit. Then we have a selling and administration expense equals operating income. Then we have a other income and losses. This is added here. Obviously, this is deducted. Other income. If other income is there, that will be added. But here we have a loss. Here we also have a loss. Okay. So if loss is there, so you will deduct. If income is there, you will add. Then we have a EBIT. So see guys, here operating income is presented separately and EBIT is presented separately. So we will prefer what? EBIT values. If this is the scenario that operating income is separate and EBIT is separate, so we have to use EBIT. Then from here we'll deduct interest expense. This will give you earning before tax minus income tax expense. This will give you net income. So please remember what was the formula for 2 years. So we need numerator is what? The degree of operating leverage in percentage. How you will take? You need percentage change in EBIT divided by percentage change. This delta represent change, okay? Percentage change in sales. So how you will calculate the values? It means we need EBIT first. So these are the EBIT values. EBIT, earning before interest and tax. How you will calculate change? So guys, what is the current year value? 150. So I'll take 150,000. Minus previous year's value is what? 125,000. And divided by previous year value, which is how much? 125,000. Multiply by 100. So this will give you what? Percentage change in EBIT. Okay, and if you will solve it, so percentage change in EBIT, which is 150 minus 125 divided by 125, it is how much? 20%. So similar way, you have to calculate percentage change in sales. Sale, this is the net sales actually. Don't take gross sales, always use net sale. You know difference between gross and net. So if you will take gross sales minus returns, etc., so you will get net sales. Okay, so we have here now guys, current year sale value is 1.8 million. Prior year sale value is 1.4 million. So how you will calculate percentage change? So you will take current year value, which is 1.8 million, minus previous year value, which is 1.4 million, divided by 1.4 million. So multiply by 100. So this will give you percentage change in sales. Okay, so just solve 180, 1.8 million minus 1.4 million divided by 1.4 million. So percentage change in sale is 28.57%. Now guys, if you will apply the formula now, what is the formula? The formula was, so degree of operating leverage was percentage change in EBIT divided by percentage change in sales, net sales. EBIT change was how much? 20%. Here it is given, right? We calculated it. So we'll take 20% divided by percentage change in sale is how much? 28.57%. And now if you will solve it, the answer will be 0.7%. And this 0.7, just we got it here, okay? So 0.7. So now we have to understand what does mean by 0.7, this 0.7. Please, now I'm going to tell you the interpretation. This is the interpretation actually. This one. Interpretation is what? Every 1% change in sale, because denominator is the same. If, like for example, if you are, let's assume, if your sale will, this, let's assume this is the sale, This is your EBIT. Now I'm telling you interpretation. If your sale will increase by 1%, 1%, this sales keep as 1%. If sale will increase by 1%, your EBIT will also increase, but it will increase by 0.7%. But what if your sale will decrease by 1%? This keep as 1 always. If your sale decrease by 1%, so then your EBIT will also decrease by 0.7%. We always assume it has direct correlation. Okay. If sale will increase, EBIT will increase. If sale will decrease, EBIT will decrease. Understood, guys? So it means here, what does mean by this answer? I already told you. Every 1% change in sale generates 0.7% change in EBIT. Every 1% change in sale. This keep as standard 1%. Okay. And then link the answer with EBIT. So every 1% change in sale generate a 0.7% change in EBIT. And I told you here, if sale will increase by 1%, so your EBIT will also increase by 0.7%. But if your sale will decrease by 1%, your EBIT will decrease by 0.7%. So this is what is called degree of operating leverage. And obviously, if again answer is higher, for example, assume answer is, let's assume 10. What it means, if your sale is increased by 1%, so your EBIT will increase by 10%. This is the answer. Okay. But what if this is not risky situation? This is good. But what if reverse the scenario? If your sale is decreased by 1%, your EBIT will decrease by 10%. So that is why it represents a risk. Risk is always downside risk, right or wrong? Downside risk, right? So this is the risky. So that is why higher answer represents higher risk, because a small change in sale can drastically change your EBIT. Understood? So this is what is two-period model. So I told you guys operating leverage. These are the formulas. Now I'm going to tell you financial leverage, because equations are very simple, but then we will practice the question. You will see how to solve the question with the passage of time. Let's go. First, let me cover now financial leverage. Okay, financial leverage. Please, guys, financial leverage also represents the risk. But this risk is arising due to your financing decision, or due to your capital decisions. Okay, capital structure decision. For example, this risk will arise due to the usage of debt. If you will use debt, obviously, if you are using more amount of debt in your capital structure, obviously you have to pay more amount of interest expense also. Right? So it means high usage of debt will increase your risk, and less usage of debt will decrease your risk. But on what will be the effect on earnings, that I'll tell you later. So here we go first. So again, we are going to discuss here financing leverage. So we are going to measure degree of financial leverage. Understood? Again, we have a two formula. So this is the first formula. This formula you will apply if single year data is available. If single year means only 1 year data is available. Then this formula you will take what? EBIT. EBIT means earning before interest and tax, divided by earning before tax, EBT. So let me show you income statement actually. Let's have a look and I'll tell you here. Let's say you have a net sales of current year, previous year, minus cost of goods sold equals gross profit, minus selling and administration expense. Okay, plus R minus operating, okay, this is equal, sorry, operating income. Then plus R minus income or losses, because income, if there is income, you will add. If there is a losses, you will deduct it. Both losses are there. Equals EBIT. EBIT means earning before interest and tax. And then from there, you will deduct interest expense. This is called EBT. Actually, in the single period model, we are using these two values. Which two values? EBIT and EBT. Earning before interest and tax and earning before tax. Because the explanatory variance for this difference, that I mean, so simply the difference between these two is what? Interest expense. It means the explanatory variance for the difference in these two values is the interest expense, which is relevant to finance. Understood? So that's when single period model will use these two values, this and this EBT, EBIT and EBT. So numerator is EBIT and denominator is EBT. Again, if answer is higher, it means risk is high. If answer is lower, it means risk is low. Why? If answer is high, it means the difference between these two values are more. It means you have a more interest cost. If answer is lower, so it means the difference between these two values is lower. It means you have a less interest cost. Understood, guys? So this is what the formula EBIT divided by earning before tax or EBT. So then here we go. Let's see, we have this income statement. This as I told you. So we have earning before tax here. From there we'll deduct tax expense. We have a net income. So let's have a look. It means in single period model. So we are going to use these two values. Which two values? EBIT as a numerator and EBT as a denominator. Simply, for example, if I'm working with the current year, so I'll take 150,000 divided by 125,000. Sorry, divided by this value. So EBIT divided by EBT 135. This is for the current year. And for the prior year, I'll take EBIT 125,000 and divided by 115,000. So here we go. So 150 divided by 135, this current year value. 150 divided by 135. And this is the prior year value. 125 divided by 115. Okay, so if you will solve, so we got the answer here. For the current year, what's the answer? The answer is 1.11. You can attach dollar here also, it's fine. And you can attach dollar here, okay? And then here 1.09. So where is the higher answer? Here answer is higher. And here answer is lower. It means here we have a high risk and here we have a less risk. Okay, now let's understand what does mean by the interpretation of this. Okay, so please try to understand the interpretation because mostly people misinterpret these ratios. So what is the interpretation? So let's assume first I'm explaining current year. In current year, what it means? The current year answer is what? $1.11. It means a company needs $1.11. This answer. Company need this of EBIT, of numerator, The company need $1.11 of EBIT to generate $1 of EBT. Please remember here we keep EBT as $1. EBT will keep as $1 here. Okay. So here answer you will relate first with the EBIT. Like company needs 1.11 of EBIT to generate $1 of EBT. On the other side, how you will interpret this here? It means company need $1.09 of EBIT to generate $1 of EBT. Same, it's written here. Like come here, company need $1.09 of EBIT, okay, to generate $1 of EBT. So tell me where we have a more risk. Obviously, here we have a more risk because here we need more EBIT to generate one EBT. Here we need less EBIT to generate one EBT. So it means higher answer represents higher risk. A lower answer represents lower risk. This is the formula which we use for single period. What is the formula? EBIT divided by earning before tax or EBT. Now, what if you have a 2 years data? Then we will apply this formula. This is called percentage change version, but for financial leverage. Okay, percentage change version, but for financial leverage. And here, please remember, here he will give you 2 years data. Okay, 2 years data. So for example, here degree of financial leverage if 2 years data is available. So then you will always apply this data, this formula. Okay. So then further things I'll discuss with the question, don't worry. So here, what is the formula? So we need here percentage change in net income. Net income is, is the last part or last item of the income statement. And divide by percentage change in EBIT. Don't forget the formula. Numerator here is the net income. And denominator is the change in EBIT. So change in net income divided by change in EBIT. And how you will calculate change in net income or change in EBIT? So you will always take this formula, current values minus previous year value, divided by current year values multiplied by 100. So this will give you percentage change. If you're using the values of net income, here you will get percentage change in net income. If you're using the value of EBIT here, so you will get percentage change in EBIT. Okay, so let's understand with the help of a same example. So I'll take you back there. So we have here first net income. Change in net income and change in EBIT. So here we go. So this, if this is the income statement in front of you, first we have a net income here, right? So how you will, this is your current year data, this is the last year value. How you will calculate change? So you will take current year value, which is 81,000, minus last year value, which is 69,000, divided by last year value, which is 69,000, and multiply by 100. Okay, so you will get change in net income. And how you will get change in, what was the second thing? Change in EBIT. EBIT, don't take EBT here. EBIT, earning before interest and tax, this value. So how you will calculate change? So you have a current, this is the current value, right? 150,000 minus previous year value is how much? 125,000 divided by 125,000 and multiply by 100. Okay, please cross check. I'm applying the correct values. Okay, so because sometimes when you write, so you can also make a mistake. So here you have a change in net income. First, we will calculate. So net income, I told you formula, current year value minus previous year value divided by previous year value and multiply by 100. So you got what? 17.39%. And then we have a percentage change in EBT. Again, current year value minus previous year value divided by previous year value. So you got what? 20% change in EBIT. Now you will apply the formula. What was the formula? So degree of financial leverage equals. So we need change in percentage change in net income, which is how much? 17.39%. And divided by percentage change in EBIT. And that is how much? 20%. So if you will take 17.39% divided by 20%, so you will get answer how much? 0.8695%. So what it means now? Just understand the interpretation. So interpretation is, now please, this is how you will interpret. Every 1% change in EBIT. EBIT is the denominator here, okay? If your denominator will change by 1%, so your net income, because numerator is a net income, your net income will change by 0.87%. For example, again, it will have a direct relation. Let's assume if your, this is EBIT, this is your net income. In the formula, net income is the numerator and EBIT is the denominator. But when you interpret it, so you will say every 1% increase in EBIT, 1% increase in EBIT will increase your net income by this answer. Answer was how much? 0.8695. And on other way around, if the EBIT will decrease by 1%, so your net income will also decrease by 0.8695. And let's assume if answer of this formula is not 8.61, let's assume answer is 3. So it means every 1% increase in EBIT will increase your net income by 3%. And same way, this is risky. Every 1% decrease in EBIT will decrease your net income by 3%. So that is why higher the answer, higher risky. High risk. Okay. And lower the answer, low risk. Understood, guys? So this is what is the 2 years formula. Now let me tell you here the question, how question will be tested. Please remember here, these 2 points are really important. It will help you to solve the question. Usually we say that debt financing is risky. Yes, it is risky. But please remember, so now I'm going to tell you the effect of, okay, the effect of leverage. Leverage, okay, especially financing leverage. So, or whatever kind of leverage it is there. So, effect of leverage, I'm going to tell you here, guys. Please remember. So, these are two conditions are there. These 2 points you have to remember. Leverage may have positive effect on your earnings, For example, let's assume if you are using debt in your capital structure, right? And you are using that debt in more productive way, okay, in terms of investment. So obviously that can create value for you also, right or wrong? So please remember here, these 2 points are remembered. If a company is less leverage, okay, less leverage means less risky. So that company may have less earning per share also. But this will happen only if sale exceeds the break-even point. Like sale is more than break-even. Like company is in the profit. Okay, but if company is less leverage, so earning per share will be less, not high. The reason, because less leverage means a less risk, right? Less risk means a less return. Okay, remember this way. So if company is less leveraged, means a less risky, it means the earn return will be less also. And on the other hand, if company is a high leveraged firm, if company is a high leveraged firm, so it will have a high earnings also, high EPS also. But this will happen only when sale exceeds the break even point. So simply remember high risk, high return, low risk, low return. Understood? So here risk was low, return is low. Okay, return is low. Here risk is high, return is high. Simply. So now guys here, but what is the condition if sale exceeds the break even? Otherwise, you have to check your calculation. What are the actual figures? So this is just to solve the question I'm telling you. Sometimes they may ask the effect of leverage on earnings. I'll show you question. So guys, here we have here data now. Please remember. For example, we have a company here. So what we are going to calculate? We are going to calculate degree of operating leverage. We are going to work. So here we go. The data. We have a financial information for year 2 operation is shown below. Okay, guys. So what is the data? So this is the year 1. This is year 2. Please, this is your current year. This is your previous year. So we have to calculate degree of operating leverage. And here we have a value of sales. We have a total operating cost. We have a earnings before interest and tax. Then we have a interest payments. We have a income. Then we have a income tax also. So this is called your net income. So this the data is available for 2 years. And whenever 2 years data is available, and you are required to calculate operating leverage. So what is the formula, guys, you will apply if you are calculating operating leverage? 2 years data. So what will be the numerator? What will be the denominator? So first of all, you have to calculate percentage change in EBIT. Okay. So if you will just remember the formula for operating leverage, when 2 years data is available. So degree of operating leverage is equals. So numerator is percentage change in EBIT divided by percentage change in sales. Right or wrong? This is the formula. So first calculate percentage change in EBIT. So here we have a earning before interest and tax. It means these values are relevant now. Percentage change, how you will calculate, guys? So please remember this is the current year value. So I'll take 9. This is percentage change in EBIT I'm working, guys. Percentage change in EBIT. So I'll take current year value, which is how much? 960,000. Minus previous year value, which is how much? 800,000. Divided by 800,000 and multiply by 100. Can you just work how much it is, guys? If you will use the calculator. So we have a difference, numerator difference is 160,000 and denominator is 800,000. 160 divided by 800,000 multiplied by 100. So it is 20%. So we got a numerator which is 20%. Now you need to work percentage change sales. So I'm working now percentage change in sales. So for that you need current sales. This is the current sales value. Net sales I need 4.4 million minus previous year value how much? 4 million. Okay, that divided by 4 million, which is previous year value, and multiply by 100. So if we will take the difference of numerator, it is maybe 400,000, right? It means 400,000 divided by 4 million multiplied by 100, it is going to be 10%. So it means percentage change in sale is 10%. Okay. So 20 divided by 10. So answer is 2. So what does mean by this 2? Tell me, guys. What does mean by this 2? It means 2. If you remember, I told you, it means if your sale will increase by even 1% only, 1%. So your EBIT will increase by 2%. This answer. But if your what if your sale will decrease by 1%, your EBIT will decrease by 2%. Okay, so answer is the 2. But here interpretation is not asking, is asking calculate the operating leverage. And what's the answer? We got the answer as 2. which is the correct option B. Okay. So now I'm going to tell you another question. So here we go. Please remember here. So we have another question. A company has a degree of operating leverage of 2. Of 2. How much should a company change its sales to achieve a 20% increase in operating income? Please remember I told you first thing. He's asking change in sale. Okay. Because he want to increase operating income by 20%. So do you remember the formula for operating leverage? Just we discuss operating leverage because here data he told you he want to achieve 20% increase in operating income. It means we have to use uh, you know percentage change method, percentage. So we have to calculate degree of operating leverage. Operating leverage. What was the formula? Percentage change in EBIT divided by percentage change in sales. So he told you degree of operating leverage is 2. Answer is given here. And he also told you if a company want to increase its operating income by 20%. So this is operating income by 20%. So what should be the change in sale? This is what he's asking. So simply how you will calculate now, guys? Simply the formula will be this way. So you will take 20% divided by 2. This 2 will be divided here, right? Equals what? Percentage change in sales. So 20 by 2. So answer will be what? 10%. Now the question is that 10% increase or decrease? This is the question. Because he told you 10% increase here and 10% decrease here also. Answer is 10% increase or decrease. So I told you it always have direct relation. If your sales will increase, your operating income will also increase. If your sale will decrease, your operating income will also decrease. And here the question is about 20% increase in operating income. Increase in operating income, obviously it means sales should increase. So answer should be 10% increase A. So this should be the answer. Now I'm showing you another question, guys. Please remember, they are telling you another question. A degree of operating leverage of 3. Operating leverage is given again. Again, it's operating leverage. Okay, we have a degree of operating leverage is 3. So at 5,000 unit means. So now here statements are given. What does mean by this 3? Degree of operating leverage. Okay, they're saying 3. What it means? So 3 means a what? A 3% change in earning before interest and tax will cause 3% change in sale? No. So we should relate first with the sale. Every 1% increase in sale. Okay, this is the interpretation of answer I'm telling you. Every 1% increase in sale will increase your EBIT by how much? 3%. This should be the answer. Don't keep it like every change, 3% change in sale will generate EBIT of 1%. No, no. Here sale is 1%. It means if your sale will increase by 1%, your EBIT will increase by 3%. If your sale will decrease by 1%, your EBIT will decrease by 3%. So you have to find out the interpretation here. So every 1% increase in sale, because our answer is 3. So let's read it here. So they're saying 3% change in EBIT. No. Okay, 3% change in EBIT, correct. And tax will cause 3% change in sale. No, not 3% change in sale. Sale should increase by 1. Every 1% change in sale will affect 3% of EBIT. So due to this part of the statement, this answer is incorrect. Let's read the option D. 1% change in sale. Yes, sales you have to keep as 1%. Will cause 3% change in earning before interest and tax. Yes. If your sale will increase by 1%, EBIT will increase by 3%. Actually, this is the answer. Now, why look at here, why C is not the answer. 3% change in sale. No, sale should increase by 1 or decrease by 1, not 3. This is incorrect. So 1% change in earning before interest and tax will cause 3% change in sale. No, sale should increase or decrease by 1%. Okay, like if your sale will increase or decrease by 1%, it will increase or decrease your EBIT by 3%. So it means option D is the correct answer. So now, guys, here, this is also a question. Please remember. So they are saying that everything else being equal. So here we have a two list. List A. This is the list A, which is highly leveraged. So you can assume list A is about leveraged. And then they're saying everything else being equal. List A, highly leveraged firm, will have list B, earning per share. This list B is the EPS. I told you if sale is greater than break even, he didn't tell you here, but usually simply remember here, if this is the risk, because leverage represents risk, right? Leverage represents risk. And this is the return. Obviously, high risk means a high return. This is very famous statement in the finance, right? And low risk means a low return. So you have to find out now option from here. Either high risk, high return means a high leverage, high return. Return means a here EPS is saying. And low risk means a low return. We have to see here. They're saying less leverage, high EPS. No, no. Less leverage should be less EPS. So this is not the answer because he wrote it higher. Then look at here. See, more because list is leverage. More leverage means say more EPS, not lower. This is not correct. Then D, more leverage, less EPS. No, more leverage, more EPS. This is also not correct. Now look at the B. Less leverage means say less risk. Less volatile means say less return because this list B is EPS. So less leverage, less return. So it means option B is the correct. Understood, guys? So sometimes this kind of question will be available answer. Now, guys, we have here one more question here. A financial analyst calculated the company's degree of financial leverage as, this is financial leverage now, as 1.5. Okay. If the income before interest, you can assume EBIT because it's before interest and tax. If it is increased by 5%, it's operate financial leverage. Again, he told you percentage here. It means you have to apply percentage method. So we have to get a degree of financial leverage because percentage he told you the percentage. So let's write the formula. What was the formula, guys? Degree of financial leverage in percentage. So formula is you have to memorize the formula, guys. If you will not memorize, so it will be trouble for you. So for formula was percentage change in net income divided by, because here told you percentage, that's the percentage formula will apply, divided by percentage change in EBIT. This was the formula for financial leverage. Now let's read the question. Okay, so they're saying that a financial analyst calculated the company's degree of financial leverage is 1.5. So 1.5 answer is given. If income before interest increased by 5, this interest and tax, if this is increased by 5%, this is denominator is given. So earnings to shareholder, earning means this net income, obviously. Net income will increase. Obviously, will increase by what? Calculate the missing value. So how you will solve it? This numerator you have to find. Simply you will multiply these to 1.5 by 5%. It will give you 7.5, which will be your net income. Right or wrong? So it means the earnings to shareholder will increase by 7.5%. Clear? Mathematically, just you have to solve the formula. Answer is given, denominator is given, numerator you have to find. That's it. Now we have another question, guys. This is a bit long question. So they are saying that since, please remember here, let's read the question because directly requirement you cannot see it here. So we have to read the question, then we'll see what he is asking. So they're saying since incorporating 3 years ago, like we were registered 3 years ago, a company has estimated credit loss. Credit loss meant to say allowances for bad debts at the rate of 3%. You know, this credit loss or allowances for bad debts is your expense, right or wrong? And expense will always, if increase in expenses there, it will decrease your income. So they're saying since incorporating 3 years ago, a company has estimated credit loss at a rate of 3%. It means previously allowances for doubtful debt was 3%. Using the income statement approach. You know, guys, there are two approaches, are there income statement and balance sheet approach. So this is the income statement approach. And this thing you have studied in the part 1. During its 4th year in business, after recording the uncollectible accounts, expense based on its previous estimate, like they're saying in the 4th year, what happened? This is the statement now. The company determined that its estimate of uncollectible accounts should be increased to 4.5%. It means if in the last year expense allowance was 3% last year, so in the current year expense is 4.5%. It means your expense has increased by 1.5%. Right or wrong? Okay. During the 4th year, Okay, because in the fourth year, your estimate is 4.5%. Last year, it was 3%. So it means your allowances, or in other word, expenses are increased by 1.5%. Now, during the fourth year, the company recorded sales is 2.5, sorry, 25 million. This is sales. And accounting receivable balance is 2, 2 million. This is irrelevant because company is using income statement approach. In income statement approach, whenever you calculate the allowance, so how you calculate the allowance, you need sales, credit sales value multiplied by allowance percentage. So this will give you allowance for doubtful debts and allowance for credit loss. Credit loss is the latest word we use it. Okay, guys. So allowance for credit loss. I'll use the same word. So because it's income statement approach, so we have to take sales because sale is the part of income statement. Receivable is the part of balance sheet. So that is the part of balance sheet approach. So this is the income statement approach. So what was the sale? So sale is how much? 25 million. It's given in the question here. See, 25 million into allowance percentage. You have to just take increase because allowance has increased by 1.5%. Because previously it was 3, now it is 4.5. It has increased by 1.5. It means your expense will increase by 1.5. So if you will take it, just calculate it. 25 million into 1.5%. It is going to be 375,000. It means your expense, because this is the increase in allowance, right? Allowance has increased from 3 to 4. So it means your expense will increase by 3.75%. So if your expense will increase by 3.7%, so obviously your income will decrease by this amount, right? By this 370. Sorry, I'm saying 3.75, not percent, $375,000. If your expense will increase by $375,000, your income will decrease by $375,000. So now here we go. So obviously, if your income is decreasing, so it will increase your risk, right or wrong? So risk will increase now because reduction in profit means a increase in risk. So here we go. So they are saying that both operating leverage times, they are saying that the change would decrease. Like they are saying change would decrease. Decrease what? Operating leverage and times interest and ratio. Time interest and ratio. Do you remember the formula? It was EBIT we studied previously divided by interest expense. So here nothing is changed in the interest expense. So that's why we cannot link. So change is in the expense itself, not in the interest. Then they're saying current year's income by, they're saying it will be decreased current year income by 1.125 million. No, current year income will decrease by 375,000. So they say current income will decrease, like this change would decrease what? The current year income by 375. Yes. And increase the operating leverage. As I told you, leverage is the risk. If decrease in risk means a simply increase in, sorry, decrease in income, it's increase in risk. Decrease in income, it's increase in risk. So this is the option actually. So here, current year income is 30,000, not 30,000. Current year income is decreased by 375,000. Okay, guys. Answer C is correct. I hope so it is clear, guys. See you next time. Thank you so much.